Hello everybody, I'm the Boss Hog and we're back with another video. We're a bit late in the weekend, but what we lack in punctuality we make up for in length. We're going to be touching on my ISAs, 3 new positions that were suggested by ChatGPT, a couple of trading updates from Games Workshop and Fevertree, and we finally got around to reviewing Medical Properties Trust latest earnings, so I'm going to be sharing my thoughts on that with you. As standard, we'll also be reviewing my portfolio, which remains just about in the green in these difficult times, albeit just. Let's do it. All right, so in terms of news this week, I'm going to keep it quite local to my portfolio. First of all, and I'm really happy to announce that I have maxed out our ISAs this week. You have individual limits of £20,000 per ISA, but I count me and my wife, so £40,000 in total. And each year, of course, that resets. So in a couple of weeks, we'll be trying all over again. Now, technically, to be fair, because I transferred some money from my general investment account to my ISA, I'm 51p short and it wouldn't let me transfer less than £1, but I think we can probably round that up and say that we hit our 40 grand target. So for me, that's a big deal. Definitely not an easy target for my wife and I to hit. And yeah, really pleased with it, to be honest with you. One of the reasons why it's so important is because both of us plan to retire early, so it's before we'll have access to our pension pot, so we'll basically be living purely off our ISA. And we plan to retire really well as well, so making sure that we have no tax on our future income is a must, basically, in order to really achieve that dream. So yeah, so really pleased. It's now the 3rd year running that we've hit this, so we just need to keep up for another 20 odd and we will be absolutely there. Next up, a trading update from Games Workshop. Now, in fairness, Games Workshop never have the most detailed trading updates. They are a company of few words outside of their reporting periods. And literally, there is one line that says trading updates in line with expectations. So, okay, that's reassuring. The slightly weird thing is, though, is that they also announced their dividend at the same time, which was a surprisingly high £1.20 per share, which I thought was a bit weird because I'd sort of penciled in 80p if they were in line with expectations. And I thought, well, why is it so much higher if they're trading in line with expectations? Anyway, if you look into the small print, they received their mentioned £12 million VAT rebate from France. This was mentioned about 6 months ago originally, that it was in progress and it would be returned to shareholders. And effectively, that's what they've done. So if you work out the maths, and I did it so you don't have to, but if you subtract the VAT, you'd end up with a dividend of 83p. So more or less, again, in line with expectations as a result of that. And the delta is basically the VAT giving back. So that felt good, basically. So we'll be getting that in a little while. I think it's gone unnoticed. I keep trying to raise this, as the Games Workshop is now a seriously good dividend payer. You're looking at sort of £4.35 on a rolling 12 months on a £90 invoice on a £90 stock. So, you know, yielding the better part of 5% for a growth stock. So I think it's really great from that perspective. Games Workshop also announced their 10th edition. Now, for anyone not familiar with Games Workshop editions, and I'll assume that's most of you, editions are like, they come around every 3 to 4 years, so they're basically on an Olympic cycle, and they're big deals, basically. Big events tend to happen alongside them, and they usually produce an increase in sales, which I'm hopeful for as well. Now, Games Workshop did a couple of things. First of all, they absolutely blasted their YouTube channel and everything else, and a couple of the videos are absolutely incredible. So there's a 4-minute cinematic. Games Workshop always do beautiful cinematics of one of the Primarchs, Gilliman, just basically giving this beautiful soliloquy as, you know, epic things happen in the background. It's really cool. One of the other nice things that Games Workshop's finally seem to be getting right is basically social engagement. So, you know, they're finally allowing comments on their videos. They seem to have active people working for them who are, like, you know, responding to comments. It's been desperately needed, and I'm really pleased to see it. The other big announcement is that the Lion, so another one of the Primarchs, basically these demigod beasts of humanity, is back. And this was like big news. I mean, one or two of the channels that I sort of subscribe to keep up to date with Games Workshop lore were like emotional about it. I mean, it was, all the announcements seem to be incredibly well received. And the other thing I'd call out as well is that in Games Workshop's own words, they're going to make the rules for the tabletop game simplified, though not made simple. And from what I can gather, and I'm going to be honest here, I don't play the game, I don't know it, I just sort of enjoy the lore. But from a gaming tabletop perspective, apparently the 9th edition was incredibly complicated and really tailored toward professionals. And believe it or not, there is such a thing. Whereas the 10th edition is going to have a much less steep learning curve, which again, the community as a whole seems to be overwhelmingly positive to. And I just think it's a really great feeling and lots of excitement. Yeah, beautiful cinematics, really exciting lore, and a simplified and potentially better tabletop experience for the people who play the game as well. So really good series of updates from Games Workshop, honestly, as well as a positive news on the VAT reclaim and a very chunky dividend coming up. So yeah, so I thought that was all great, and I'm really positive about Games Workshop. I still think the shares trade at a slight discount, honestly, and I'm still very happy to be owning a fair chunk of Games Workshop, which I think are my fourth largest position. Next up, we got Fevertree. Sorry. Now, anyone who follows this channel knows that I personally love the brand and love the product of Fevertree, but it's fair to say that it's been through a difficult couple of years. It basically expanded at the wrong time and ran into costs from both freight and bottling plants, so glass production primarily. And if I'm honest, I don't think it reacted very well to these adverse situations. And I was kind of crying out for a sort of more industry heavyweights last year, so I was absolutely thrilled when a guy who had previously been the CFO for SAB Miller basically is their chief non-exec director. I think that skill set was definitely needed. My only slight concern is that they still need an operational expert from one of these big drinks companies or, you know, consumer companies. But there was some promising, I would class the update as broadly reassuring. Numbers were reaffirmed for the current year. Dividend was increased very slightly. But yeah, there was a lot of good news about sort of focuses on cost cutting. Non-UK revenue growth was really stellar, I would say. But for me, I was slightly underwhelmed by some of the cost cutting initiatives, which, although they've been mentioned quite a lot, haven't yet really borne out any fruit. What this really means is that if we look at 2023, their revenue guidance of 400 million, their profit guidance of 39 million at midpoint, you're basically looking at about 10% net profit business, which, to be fair, is fine. But this is a company that trades above a 40 PE at the moment. And to me, to justify anywhere near that kind of PE, you need to do better than 10%. Now, in the past, Fevertree was a company that was almost on the 30%. It was just throwing off money. And it had really just achieved this sort of peak sales in the UK, and it was just churning out cash, basically. It's had a fairly difficult international expansion. It still has problems with glass costs, and you know, again, it said all the right things in terms of sort of making the glass production more local so they don't have freight costs. They do also expect glass production costs to keep on falling. It's an energy intensive process, so energy is obviously expensive, especially in Europe at the moment. So again, I think strategically everything that Fevertree say makes a ton of sense, not just in terms of their cost cutting, but their direction of travel as well. Beautiful product, wonderful brand. It's just operational execution has been a bit underwhelming for a couple of years. For me, I would view this trading update as reassuring and putting a floor on the share price. It was good. Like it wasn't anywhere near to how good it has been in the past. And honestly, I thought the kind of 12% one day share price rise was a bit overdone, to be honest. I'm still very skeptical about whether the company can execute on it, to be frank. And my plan is really to hold these shares until 2024 and see what my feelings are. Like, as a consumer of Fevertree, I desperately want it to work out. I want them to be successful because I think, honestly, people should enjoy the product. Yeah, there's also some really good stuff as well about them moving into like the adult soft drink category. So things like ginger beer and, you know, Sicilian lemonade. They're kind of starting to really improve with their standing in those kind of markets as well. So, you know, without being a mixer, although that's still their bread and butter. But again, I think that makes a ton of sense also. So lots of positive news from Fevertree. For me, it still remains a hold, especially at these kind of multiples. You know, maybe if you got a chance to pick it up under 1,000 pence, £10, it'll be worth it. But honestly, I think after this trading update, you won't get near that again. You could take the argument that Fevertree is never cheap. I mean, it's traded in the like 60 P's in the past because it has so much potential. But it is just that at the moment, I think. So right now, although it's cheap by Fevertree historical standards, I think there's a lot of uncertainty, and you'd have to have real conviction both with the strategy, but also the ability to execute on the operations to fulfill that strategy in order to buy this. So I have a mid-sized holding in this, about 0.6% of my portfolio. I plan to keep on holding. There was nothing dreadful in this trading update at all. I just wish they'd move a bit faster, grow a bit quicker, and justify these kind of PEs. But again, we are optimistic. So broadly speaking, I thought it was okay, but it just solidifies my opinion that this is a hold at best at the moment. All right, so next up, I watched a video by Andre Gic. I've also played around with ChatGPT myself, actually specifically for work-related reasons, and I found it was okay. I was asking it questions about certain regulations and etc. So I decided anyway to copy off him as well as I was curious just how good it was. So I decided to ask it a bunch of questions, and the question that we arrived at after 3 or 4 different sort of, it was suggesting very basic things, broad-based indexes, ETFs, etc. One of the things it said there was some factor-based ETFs, which, I mean, I didn't really know this terminology beforehand, but basically specific segments or specific markets. And I thought this was interesting because currently this is my general approach to buying ETFs at the moment. I have quite a lot of my wealth in pensions where I already have very broad-based exposure. So really my ISAs are intended to be a bit more high risk. And so I haven't currently got any broad market ETFs. I just don't think it's necessary for the size of our ISA at the moment. Maybe in a couple of years it would be. But right now it's basically, buying segments and regions, etc. So I asked it to give me some. The question there, or the end of the question, is just there. I thought this was kind of interesting in terms of the 7 recommendations that it had. So going down these, I already basically have an equivalent for points 1, 3, 4, 5, and 6. So when we look at the portfolio, I'll call these out, but just trust me that I have them. But point 2 and point 7 I actually don't have. Now, point 2 is an interesting one. And as you'll see, I basically bought 2 different ETFs for this, one specifically focused in India and one just a more general emerging market ETF. It's something I've been thinking about for a while, and when I first started investing almost 2.5 years ago now, I did actually have an India ETF, but it was quite expensive. I never really got too into it, and I was mainly focused on individual shares at the time. So I would say there are 2 ETFs that I considered specifically for India, which was JII and India, so NDIA. I decided on JII just because I liked their top holdings more, specifically Infosys, rather than Reliance, which is the big one in India. So for me, I've worked with Infosys before, and TCS I've worked with plenty, including at the moment, and Tech Mahindra as well. I've also not directly worked with, but employed a bunch of people from there. So I kind of know what India's software capability is like, way more than I do the sort of behemoth Leviathan monster that is Reliance. So I just felt a lot more comfortable with it, basically. So I don't consider myself an expert in Indian stocks at all, but that was my thinking. And then we also got just a general emerging market ETF. Now, I was on the fence, actually, about getting one with or without China. In the end, I decided to get one with China. I do already have some exposure to China through some of my ETFs anyway. On the whole, although I owned Alibaba in the past and, took basically flat, but down a couple of percent because I sold out before the drop, I'm very uncomfortable about owning Chinese shares. I also got very badly burnt by having a couple of Russian miners in my portfolio, so it sort of makes me quite sensitive to political risks. But when you have it as spread out as an ETF, I think it definitely minimizes the risk. And to be fair, China does definitely have a lot of potential that it could capitalize on, but I'm not entirely convinced by the more bullish arguments of China. But anyway, I did decide to go with one that did have China exposure as well. I do think emerging markets could overperform. So by having both a general emerging market as well as an India focused one, again, India I think will do well in the sort of medium to long term, certainly the time horizons that I'm looking at. And it's similar really to my argument with having a Canada focused ETF, which is that it gives me certain exposure to things I don't have elsewhere. I think the economic situation is going to be favorable, and I just, I think it's okay to have a geographic focus. So obviously there's big differences between Canada and India, and just sort of using them to explain 2 different regions. And also, like I say, Indian stock market is quite expensive, in my opinion. There's lots of hype around it though, but completely, I can understand where the hype is coming from. I do think there's a lot of potential in India to become a real powerhouse, and therefore I think it's important to have exposure to it. The other one here, point 7, is an interesting one because I have been somebody who has been supportive of utilities, but mainly focusing on infrastructure of pipelines. So, EPD, I was also into Enbridge at one point as well, and a few others. And I have even considered an ETF of the pipelines, but didn't pull the trigger. So this one I thought was an interesting one, really, in infrastructure, just because I don't have any exposure to it. It does seem one of the more defensive things, like when you actually look at the the segment split in this ETF that I ended up buying, that we'll touch on in just a second, it's something like 42% utilities, so it's going to be ultimately very defensive. But again, I think that's okay. Like, I do have a small position in consumer staples as well. Again, not really too exciting for me. Utilities I do get slightly more excited about. I have owned National Grid in the past. I do have a fairly large chunk in a telecoms company, although more of a high growth than an incumbent. But I'm more excited about utilities than I am about staples. But overall, I thought it was a fair shout. It's something that I probably should have 1 or 2% in to sort of give my portfolio a bit more defensive in nature. I would say a lot of the defensive stocks at the moment look very expensive to me. It's one of the reasons why I haven't been buying too much of my consumer staples ETF, not just because I find it incredibly boring, but I think it looks really expensive, like a 20 PE when you've got like tech that's 15, or some of my semi stocks are like 7. It just seems like you're overpaying at the moment for that defensive quality. That, again, I'm pretty sure in the 5 to 10 years it'll be silly. I'd rather be buying sort of tech and indeed financials at the moment as well. Still, though, I think it does make a ton of sense to start averaging into some of these more defensive ones slowly. And my hope here would basically be to build up a fairly small position, and then when the market becomes more bullish, then presumably other things like tech and financials will become very expensive, and instead I'll be buying this. But I do think it's important to have both emerging markets and infrastructure in your portfolio. And so I had a very small amount of extra money left over in March, and so we've opened up 3 positions. Again, we'll touch on them in my portfolio breakdown in those. Yeah, so 1 in India, 1 in emerging markets generally, and then an infrastructure one as well. So I thought, to be honest with you, that ChatGPT is okay, and for me, I think a lot of the underwhelmingness of it, and similar, by the way, not just ChatGPT, but equivalents as well. I think people are expecting kind of a general AI, or an AI that isn't stupid. Like, ultimately, AI at the moment, at least, is just a tool. It's like blaming a hammer because you balls up putting the nail in a piece of wood. It's like, no, it's on you as the craftsman to ask the right questions, to test the certain scenarios, etc., etc., and then to like interpret and analyze the outputs to see if it has any merit. And I think, like, for me, as somebody who plays chess quite seriously and has enjoyed the development of chess engines over many years, what's happened is chess engines now just destroy even the best players in the world, can't compete with the best chess engines in the world. But what's been happening is the best players have been using chess engines to improve their own game. And there's never been better players, right? Like, okay, Magnus is an absolute monster, sure, but you look at like the top sort of 20, they're not too far behind at all, especially like everyone else except Magnus. Their ELO ratings are just incredibly good. And just to put this into comparison, like when chess started to get serious, like the end of the 19th century, there was a guy called Paul Morphy, and he was so good that basically he struggled to get a game. He just completely dominated. And by today's standard, he'd be about as good as me. He's about 21 to 2200, right? Which is a solid player, but not even approaching a titled player, really. And now we've had to introduce like a brand new criteria, Super Grandmaster, just to try and give account for like the best 50 people in the world who are just absolute monsters, whose game has been immensely improved by computer analysis, basically. And you've got these great players who are able to make themselves even better as a result. I kind of see the same future for a lot of AI in general. I don't think AI will replace people as a whole, although there are certain jobs that I can see going. I think what it'll do is if you're a lawyer, you'll just be able to like find me case precedent where X, Y, Z, right? Or find me a statute where this is the case. Or if you're a journalist, right, find me a situation where this happened, right? So instead of having to trawl through masses of data as a poor, junior analyst, you'll just be able to pick up and ask the questions. The only concern, of course, is making sure that you don't sort of kneecap, that junior analyst or that junior journalist coming through who would have previously done the grunt work. So we have to be a bit mindful about how we use AI, sure. But for me, I'm really excited about the potential. It'll be very interesting to see how this stuff performs. And without further ado, let's have a look at my portfolio because we've still got quite a lot to cover. All right, so as has become tradition, we're going to just have a look at our weekend closing figures. It was actually quite challenging. You can see here that there's been a big net deposit difference of 3k. 2750 of that was to finish topping up one of my ISAs, and then I actually had £250 spare that I didn't expect to have, that I decided to use to open up some new positions, as we've already touched on with ChatGPT. There was a small increase in our dividend here, but overall our profit reduced quite substantially. Again, we do remain green, which is better than we spent much of last year. It's just a bit of a shame that we've fallen back quite substantially since early February when we were at our record high. Broadly speaking, again, I continue to actually view this as probably my best mental state, which is that my portfolio is still green, but I don't feel like I'm overpaying for anything. And as you'll see in a second, my general approach remains the same, which is that I'm very heavy into tech, financials, and small growth companies. Basically, that is my main focus at the minute, whilst the current market situation is ongoing. Trying to think about things from the long run and not let any short term distractions cloud my thinking. So, if I just go back up to the top and then we'll scroll down as per usual. So I've updated this now to start a new week afresh. We're almost going to be able to do plus 14 weeks, so 3 months. We are 2 weeks away before we'll be able to see that as well. But this kind of gives a pretty good picture in terms of the trading 212, which is my brokerage, as well as the Google Docs. There is quite a big delta this week, actually not in my favor, where trading 212 has my profit at 411. Google Docs has my profit at 75. I suspect this is just where a share price didn't update on Google Docs. It's usually Google Docs, which is incorrect, but we display both because I think it's important that we have that reconciliation. And I do expect this to sort of normalize as soon as the market's open and Google Docs gets back up and running again. As I've already touched on, there has been a kind of tightening of the performance in terms of time weighted. So we remain in second place against the FTSE 350 with its focus on commodities and defensive nature, but not a ton of change, honestly, since last week. And the S&P is actually holding up quite well this month, I think because of its heavy tech weighting. Again, here, both of these graphs are basically showing that we are eking by the smallest amount into a profit. So, as we've already touched on there. My top 5/6, if you include Scottish Mortgage, hasn't really changed there. But we'll just scroll down this fairly quickly. So I did get a decent sized dividend, honestly, from Amcor. They put up their dividend by 50%, so a very sizable dividend rise, although they do have an incredibly low payout ratio and definitely not what I would class as a dividend stock. But, a few more 50% and it may well change. So this, I mean, obviously it's a huge position. So in the scheme of things, getting sort of 40 quid for a quarter isn't exactly a huge amount, but that's not really the main reason why I own Amcor, which is that I just think it's fundamentally significantly undervalued. So we continue to do more of the same, basically. I decided not to reinvest my dividend into Amcor, and that's really just because I have so much in it already. And actually, I'm very green on Amcor still, up by even after the significant fall from when it was like trading in the 30s. I still remain up like 25%. So it just, I don't have a ton of unrealized open positions at the moment that are green, so I just felt like a bit of a shame. And instead, I decided to average into SMT. Now, this is basically one of my 2 growth ETF focused, so it's just a fairly small addition, no new capital. Now, SMT did have a bit of what's in the news this week, because basically one of its non-execs decided to resign and basically go out in a bit of a fireball, particularly scathing about one of the directors and basically the hiring practices specifically. He did highlight that, like the method of valuing companies and everything else was robust, etc., etc., which, I think if he'd have gone out and kind of torched that as well would have been more of a concern, because especially if you take the bearish argument about SMT, this is an ETF, or actually just a fund, with 30% of its asset value in private companies, which for me is really exciting because I don't have another opportunity to invest in private companies. But there are criticisms that SMT, basically, the only reason it's trading on such a discount against its net asset value is because it kind of hasn't priced these private investments correctly. Now, in fairness, I addressed this about 6 months ago, and I was really happy with what I read, which was that basically, they reprice them every 3 months or more often if various scenarios are hit, like, a competitor gets bought or something like that. And they also have an independent third-party auditor as part of this process just to make sure that their valuations are reasonable. So I don't really know what else SMT can do to address this. And for me, it's just a great opportunity to buy risky, high growth, high risk, high reward companies kind of thing. For a significant discount against net asset value at the moment, over 20% when I'm buying these shares, which for me is just an easy position. I also, as I've spoken about before, increasingly like SMT's top 10, specifically things like ASML is, I think, going to become their largest holding fairly shortly. So that for me is a real gem, as well as some more interesting growth companies that I'm less familiar with, but still some good. I like to say I like the direction of their top 10 in general. So as I mentioned, I added 3,000. 1,000 of that went to IDP6. This is my small cap S&P 600 ETF. For me, this is a beautiful buying opportunity at the moment. I actually managed to time this kind of okay. So on my specific buys here, I ended up, you can already see, slightly profitable, although only just. Overall, my position here is down, but just a couple of percent. And for me, I'm buying this quite rapidly because I think it's a bit of a discount, honestly, at the moment. So again, I'm more than happy to buy into these kind of sized companies, which is about $750 million to about $3.5 billion. So my favorite kind of company to own, really, in that kind of sweet spot. Another place that got actually the majority of my fund was HCAN. So this is my Canadian focused ETF. I didn't previously have a massive position in it, not tiny, but just a couple of percent of my portfolio. I decided this was a great opportunity to buy very aggressively. The main thinking here was that it's been a bit beaten up because it has a 43% exposure to financials. That to me is one of the benefits of owning HCAN. I get access to the Canadian market, as well as the fact that I get to beef up my financial slice, which especially when I'm when I first opened this position was really blank and very insurance focused rather than banking. So again, for me, even within my financials, this is filling a gap. So this is really positive for me. Again, I think here I'm very comfortable buying at this kind of level, and it was a great opportunity for me to put some real money into it. I did think about adding more into a Alliance Technology Trust because I could have actually picked this up at like 212, which in hindsight maybe was a bit of a missed opportunity, and I was a bit stubborn because I really wanted to go under 210, which is my buy price, and it just wouldn't quite go. So I was like, So in the end, I ended up going for HCAN. I think in hindsight, I should have probably put maybe 1,000 into HCAN and 750 into my Technology Trust. I could have done it. It's in the same ISA. So that was a bit frustrating. It was I think I was being a bit too stubborn where my HCAN position was slightly red, my Alliance one was slightly green, and I was like But again, this here is my big tech ETF, and this here is my my financial / regional one. And just linking this back to what we touched on in terms of ChatGPT, right? This is my small cap exposure. This is my big tech exposure. So we're starting to see this. This is another of my small cap exposure. So again, big focus for me with my 20-year horizon and fairly high risk tolerance. If I just scroll down a little bit, you can see here, by the way, that Fevertree drinks, again, really positive, really well received trading update. I think this 15% was a bit generous, frankly, but obviously the market really loved it, and I think it kind of started to allay some of the concerns around Fevertree. If I just go down here, so this is one of my sort of tech ones, the robotics and automation, right? Again, called out by ChatGPT. Digital security, I would argue, is kind of similar in terms of the focus. Then we've got our clean energy here, our INRG. I know quite a few people own this. I think I've got an okay average here, but I am definitely down about 5%. And then we've got our healthcare one as well. So again, I'm down here a few percent, I think about 3%. So none of my ETFs are down particularly badly, with the exception of Scottish Mortgage Trust, if you want to include them, which is down about 10% at the moment. But again, I'm very comfortable with my average there, just because I think it's so undervalued. And then these are the three positions that we ended up opening thanks to the ChatGPT. So again, as I've already touched on, these are the exact tickers. So JP Morgan Emerging Markets. So that does include China. There is a non-China equivalent for anyone who doesn't want the Chinese exposure for whatever reason. Then I've got my India one here, and then we've got our iShares in this regard. So BlackRock's global infrastructure distribution, actually. So that's an interesting one. So you can see here that these are very small positions, but that's mainly because I have maxed out both of my ISAs, as we've already touched on. And the plan will be is that once we have a new year, we will start to basically transfer these into my ISA, but I have to sell and then add. So we're basically putting the £200, 250 into my general investment account. You can see here, by the way, up 83p. What a result. Down 24p and down 44p. So I guess overall I'm technically slightly up, so we should take that as a win. But I do, like I say, plan to add to these quite aggressively, so you'll gradually see them go up this list as we continue to buy. Not much else beyond that. My sector change here is still broadly the same, so extremely heavyweight. I've started to prefer to look at the graph on the right here just because it breaks out my ETFs. So, and yeah, the financials here, again, I'd like to get my financials north of 15%, but definitely happy with the direction of travel that that's going. And my technology here, I've decided to cap at 50%. So once we start getting to 50%, we won't be buying any more tech. But for now, I'm happy with the percentage. Again, I think my time horizon is more than justified holding this kind of split. We do plan to add the utilities. This is going to be our infrastructure and our healthcare, which we've already touched on. And really, I'm starting to like most of the things around here in terms of defense and industrials, and REIT here as well. I'm happy with my 5%. So broadly happy, just need to sort of beef up one or two of these segments as well. And then in terms of dividends, again, we continue. I can't wait for this to get to 10 grand, by the way. That's going to be amazing. But short of my Amcor dividend, we didn't receive anything else. I do technically have 3 dividends due by the end of the month, but 2 of them are on the 31st and 1 of them are on the 30th. My brokerage usually takes a little while to pay these out. Together, they're about £90, so it's not trivial, I would say. And I will obviously put them into whatever month they fall in and bring to you when they get them. Anyway, that's my portfolio for now, which, like I say, hangs on to green just about. But next up, we're going to have a little look at Medical Properties Trust, MPW. Let's do it. All right, so finally, Medical Properties Trust. A bunch of people have asked me about this. I have in the past been quite optimistic. I guess a lot of people were saying if the latest results and various pieces of news make me reassess. So again, this is my first chance I've really had to look at it. In fairness, the latest earnings call was quite short and sweet, honestly. The actual presentation was only about 20 minutes. MPW do provide supplementary information, which I personally enjoy. It's good because you get to see the sort of underlying health of their customers, understand the split of their customers as well, which is going to matter in just a second. And broadly speaking, I thought the earnings call was fine. They answered most of my concerns, and the ones that they didn't answer, the analyst did a good job of extracting. I would say there's one point that is worth raising that was concerning for me. But broadly on the whole, I felt that the slide was completely overdone compared to the scale of the problems, but it did potentially kind of validate some of the more bearish arguments about MPW, which maybe was part of the reason for the slide. From my perspective, Prospect, which is the customer that is gotten itself into all kinds of trouble, this accounts for about 7% of their base, so definitely a significant customer. Although MPW do expect to recover all of their investments, which can be split between, the value of the properties, the rent, and the investments they've made, which totals about 420 million. They expected to take 12 to 18 months to work through, so a significant delay. And just by reading between the lines, and again, the analyst did a good job of extracting this information as well, making it a bit more concrete, I don't think we should expect to receive any rent from Prospect, specifically in Pennsylvania, so excluding the rest of their estate, in 2023. A lot of the way that MPW, I believe, are going to be looking to recoup this value is going to be in the sale of their properties. That's basically it. They're still working with a bunch of other creditors to aid Prospect. They made clear that basically from their perspective it makes sense to support the Pennsylvania arm. They don't expect to get any rent, and yeah, they're looking at a 12 to 18 months, so basically beyond the current financial year. They were quite clear about this, to be fair. But yeah, so I think that's it. But yeah, they do actually potentially expect to require to provide additional support in the sort of form of bridge loans for rent payments and that kind of stuff. So I do expect Prospect in Pennsylvania to be quite rough. They did make clear that they expect to receive rent from the rest of Prospect, so the non-Pennsylvania estate, over the year, and did have to be asked about 3 times whether they have received rent from non-Pennsylvania hospitals for Prospect in January, February, and said that they had, although basically it was a bit late arriving. So again, it's quite concerning that a material part of their business, Prospect specifically, is in that much trouble. As a result of this, they're currently guiding for 150 to 165 per share, reduced from 179 previous to this issue primarily, as well as 1 or 2 that we'll get to in just a second. Basically, that range at the lower end assumes that they receive no rent from Prospect at all, so the whole estate, not just Pennsylvania but the rest of it. The upper, the 165s, assumes that they receive rent from Prospect for everything outside of Pennsylvania. So again, that's probably realistic. That's what they were guiding for. That was their most realistic scenario. Worst case scenario being £1.50. I would point out that because of the share price slide, assuming that these figures are met, even if we take the 150, this is basically a current year PE of 5 at the moment and a yield of 15%, assuming that the dividend remains, which again was mentioned on the call, that they felt that they have more than enough, income to cover the current committed dividends, basically was their exact wording, rather than promising to increase it. So I'll be interested to see if they do choose to increase it or whether they keep it flat. But yeah, there's that. I would point out, and this is definitely a bearish argument I've heard, and it looks really bad on paper, that their investment / loans into their customers is very high, currently 34% of market cap. It was actually said 36% on the call by the analyst, so 34% is my number. I think I've calculated it correct, but again, it's in the 30s anyway, the mid 30s. One of us is wrong, but not by very much. And yeah, it's really high. They did lend an additional 1 billion over 2022. Again, this is a fairly normal part of their business, and usually it's been between about 15 and 20% of their market cap. However, like when you look into it, really the only reason it's such a high percentage is because of their market cap slide. Like if you actually like compare this to sort of 6 months ago, which is what I did, you get 17% of market cap, which is much more normal compared to what they've been dealing with. And again, they have been receiving income from their investments they've made previously, although as Prospect points out, there is this kind of risk that features into this. So it'll be interesting to see how this shakes out exactly. But I think it's worth raising that currently at the moment a lot of medical properties trusts is their, I guess, implied market cap is tied in with the loans and joint ventures that they've taken with some of their customers. I would say this is a real win for me, and I think it kind of got completely overshadowed by the Prospect information, but the situation with Steward is significantly improved. And for me, the bearish argument is always focused on Steward. Like when I first got into MPW like 2 years ago, and this is actually my second time in MPW, so I did sell out fully and then came back again. Wish I'd stayed away, honestly, but it is what it is. So Steward were always the biggest risk, right? At one stage when I first was into MPW, it was 30% of their base. That's now fallen to 21% by assets and revenue. It's closer to 20% for assets and closer to 21% for revenue. But what's happened is basically Steward's Utah hospitals have been sold to a company that is much better than Steward. So for me, that's a big win. An investment grade hospital provider that apparently is really great. And as a result of that, this new company becomes 6% of their base. And as a result, also Steward has gone from sort of mid to high 20s to 21%. So what this also means for Steward actually is, an MPW, again, we're very clear on this point, that there's a lot of belief that Utah was Steward's crown jewels, but actually that's not the case at all. Really, Florida is Steward's crown jewels, and as a result of disposing of their Utah hospitals, the rest of Steward that remains has better rent coverage. So it's become a safer customer, basically, from MPW's perspective. So just to be clear, what's happened is that their largest customer has shed about a quarter of its exposure, and that quarter has been passed to a customer who's significantly better in terms of their risk profile. At the same time, what we've had is a much better Steward remaining. So this is like a double win, basically. The commercials seemingly were fine as well. I didn't think it was like an amazing resale, but it was fine. It was kind of fair value, I guess, as far as I could tell. I won't pretend to be like a real expert in this, but I did sort of have a look at the numbers, what MPW had invested into Steward, into Utah, and was sort of, okay, broadly happy. And I think for me, the win isn't actually the financial, it's the customer split. You pick up a new customer who's much better, and your riskiest customer, at least before Prospect happened, is now much safer. So I think that's actually a huge win that kind of got ignored, broadly speaking. I also had a look at the coverage, which I think is really important, because they do have like something like 2/3 of their bases in general acute hospitals, which are definitely under financial pressure. That apparently is a situation which has been improving over 2022 and is expected to improve moving forward. Some of the inflation drivers is coming down, and generally the hospitals are getting into better shape overall, although obviously Prospect didn't come through completely unscathed. I would point out that, again, about a year ago, when Steward was the biggest risk, MPW took pains to point out that they've had big failures beforehand and were able to basically repackage hospitals and sell them on. Certainly one of my preferred reasons for investing in a healthcare REIT that deals in hospitals is that they are very desirable things. It's not very easy to build a new hospital. They often serve huge, massive amounts of people. And so they do command resale values, and they do attract tenants who will provide healthcare. So for me, looking outside of Prospect, the remaining parts of the business, most of it has greater than 2x coverage, and a huge majority is more than 1.5. There's one basically that's 1.2 that looks a bit worrying, and there's a couple that are like 1.5, 1.6, but a lot of them have, I mean, some of them actually have like 8. So they're definitely in no danger at all, though that is unfortunately some of the smaller customers. But most of them are in the sort of 2 to 3 or 1.5 to 3 kind of area, which again, when you sort of read reviews and compare them with some of MPW's competitors, I would say actually puts them in a slightly more favourable light than against some of the competitors. I have also been reading up, and some of the bearish concern is about the refinancing required in 2026 and 2027. For me, I'm not overly concerned by this. The refinancing isn't massive, and I think there is just like this concern that because of MPW's credit scores with Moody's and Co being basically non-investment grade, it's the one below, I think it's BA -1 or something. But there is some concern that basically the rates that they would be charged would be significantly higher. I don't want to like downplay that risk, because I do expect their rates to creep up. They do, within the supplementary information, also produce sort of a blended average of their current loans, and they come in at 3.6%. So definitely, I would expect that to be eking up as this stuff comes. But again, you're already looking at basically notes that are that have like a 5% yield, and they're not exactly cheap loans already. They're also not exactly like huge. They're sort of like 5 to 15% of the market cap of MPW, so definitely significant, right? So combined, they're like 25%. So they definitely do need to start thinking about this stuff. But again, I think it's one of those things that even if the costs do increase of those loans, which is feasible, I don't expect it to be a material concern to MPW. So again, this is like a new bearish argument that I've heard that I just wanted to address. And for me, like I say, it's not really a big thing. What I think the last couple of months have shown me is that some of the main bearish arguments here about the health of some of their tenants is definitely being realized. And it's interesting to me that it wasn't Steward, which was considered the weakest, but Prospect, which has run into this trouble. Anyway, I haven't got much else to add. I think my daughter's about to be put to bed, so sorry for the background noise there. But broadly speaking, my opinion about MPW is broadly unchanged. I might want to knock sort of 10% off my aim price, so I'd basically be reducing my target price from sort of $20 to $17.50, something like that. Again, at the moment there's a lot of uncertainty, so I think it's okay to speak in broad terms, but I still think that the risk reward here kind of stacks up. It's definitely not the best company you've ever seen, but that's always been the case with MPW and in general getting involved in the healthcare REITs. But as long as they can stabilize the situation with Prospect, as long as not too many of their other hospitals are going to be influenced as well by similar kind of problems, you've actually got a significant amount of upside here. Again, definitely more for the riskier play, I think, because again, there are definitely valid reasons to stay away from MPW. And I would say, unless you have a reasonably comfortable risk level, probably isn't for you. But if you do, I think there's actually an okay business here, certainly better than a P of 5 and a yield of 15%. So again, I'm no longer able to buy individual shares because my wife works in private equity and has the insider information, which is a shame. But MPW would be one at the moment I would be looking to average down on, just because I think that you basically get value here. So as long as you're okay looking for value rather than top quality stocks, I think it could well be for you, because again, even if I'm being slightly generous with my target price, maybe it's more like $15 or $13. Again, it just looks so cheap at the moment that as long as they can get through this year, especially if Prospect does start to, produce rent and hopefully produce a kind of break-even plus on their investment, then I think you'll see a lot of things improve for this business. So for me, I think the earnings call, which some people said was really bad, I didn't think that at all, basically. And by the way, it's 20 minutes, so if you're not sure, just go and listen to it. I thought it was okay. And yeah, broadly speaking, that was my takeaway. So it does, in my opinion, it does reduce my target price slightly, but I had an optimistic target price of sort of a 20. So yeah, so I would be inclined to reduce it by sort of 10+%. So maybe something around 17.50 is my personal target here. So again, I have no plans to sell this. I have previously, by the way, just to show I'm not too stubborn, sold a very red when I sort of really just fell out of love with the business or the management team. So, but I just have no reasons to feel that way basically. So yeah, I'm sticking in with it. I think it's potentially a buy for a riskier person, or a hold or buy if you've already got some exposure. So yeah, sorry it's taken me so long to get to MPW. That's my feedback basically and my thoughts. I don't have anything else to add this week, but thank you very much for watching, everyone. I've been the Boss Hog, and good luck with your investing. Bye for now.